Did you know that a 3-digit number could be the difference between buying your absolute dream home and being forced to rent for a little longer? Or that this single number could literally cost you tens of thousands of dollars in extra interest over your lifetime? That number is your credit score. If you've ever stopped to ask yourself, what is a credit score? You are definitely not alone. It's easily one of the most misunderstood parts of personal finance, especially right here at home. Today, we are cracking the code on your Canadian credit rating. If you've been struggling to figure out how to navigate the banking system, or you just want to know how to master your finances and keep more money in your pocket, you are in the right place. By the end of this video, you're going to understand exactly how the credit bureaus calculate your number, the hidden traps that ruin it, and the exact steps to build a bulletproof credit profile. If you want to build wealth in Canada, you have to understand the tools available to you. On this channel, we explore the specific strategies like accessing cheap credit, investing, real estate, budgeting, and other topics. We want you to keep more of your money and grow it faster. Let's get started. First things first. What exactly is a credit score? Think of it as your adult financial GPA. It tells lenders, banks, and even landlords how trustworthy you are with borrowed money. In Canada, your score ranges from 300 to 900. Anything over 660 is generally considered good, but if you want the absolute best mortgage rates, something I see clients aiming for all the time as a financial planner, you really want to push past that 725 or 760 score. There are two main credit bureaus calling the shots here: Equifax and TransUnion. They collect all the data from your lenders and compile your credit report. Fun fact, your score might be slightly different between the two bureaus, and that is completely normal. Not every lender reports to both, so the data can vary. Let's get into the actual math. How is this 3-digit number built? To truly understand credit score mechanics, you have to know its 5 distinct pieces. Number 1, and this is massive, payment history. This makes up 35% of your score. A single 30-day late payment on a cell phone bill or a credit card can tank your score by 50 to 100 points almost overnight. It's wild but true. You must always pay on time, even if it's just the minimum payment. Number 2 is credit utilization, sitting right behind at 30%. This is simply how much credit you're actively using versus how much you have available to you. If you have a $10,000 limit and a $9,000 balance, you look risky to the bank. You are maxed out. The golden rule? Keep your utilization under 30% at all times. The other 3 factors are credit history length at 15%, credit mix at 10%, and new credit inquiries at 10%. Opening 5 new store credit cards in one weekend just to get 10% off a pair of jeans? Yeah, that's going to hurt you. The system wants to see that you can manage different types of debt over a long period of time without desperately seeking out new loans. Tracking all these numbers, your utilization ratios, and your payment dates, it can honestly feel like a full-time job. And you already have enough on your plate. That is exactly why I built an entirely free tool to do the heavy lifting for you. Head over to financiallywise.ai right now. It is a completely free personal finance app where you can effortlessly manage your monthly budget, track your investments, crush your debt, and map out your biggest financial goals. Best of all, it comes with a personalized, AI-powered financial coach built right in to guide you every step of the way. Go to financiallywise.ai, create your free account, and let's get your money working for you automatically. Let me tell you a quick story about why knowing this stuff is so crucial. I had a conversation recently with someone looking to buy their first home. They had a great income and a massive down payment ready to go, but their credit score was hovering around 620. Why? Because a few years ago, they paid off all their debt and immediately closed their oldest credit card. They thought being debt-free meant shutting down old accounts. Big mistake. By closing that old card, they wiped out a huge chunk of their credit history length and instantly spiked their overall credit utilization on their remaining active cards. Because of that 620 score, the bank offered them a mortgage rate that was a full % higher than the regular rate. They were told no exceptions. On a standard mortgage, That single misunderstanding was going to cost them tens of thousands of dollars in extra interest. Understanding the rules of the game is literally worth its weight in gold. So, how do we fix it? When looking to improve credit score, Canada standards are actually pretty straightforward to follow if you know the right steps. Here is your action plan. Step 1. Pull your free credit report. Look for errors. You'd be absolutely shocked how often a bill you paid off 5 years ago is still showing as outstanding, or someone else's debt accidentally ended up on your file. Dispute those immediately. You can pull your credit score for free using Borrowell. The link is in the description. Step 2. Set up auto pay for at least the minimum balance on every single account you have. Never, ever miss a payment again. Automation is your best friend here. Step 3. Call your credit card company today and ask for a limit increase. This sounds counterintuitive, I know. But if you get a higher limit and keep your spending exactly the same, your utilization ratio drops instantly. Boom, your score goes up. Building a strong credit score isn't an overnight magic trick, it's a long-term habit. You need to pay on time, keep your balances low, and let your active accounts age like fine wine. Treat your credit like an asset, because it absolutely is one. If you found this breakdown helpful and you feel more confident about your finances today, smash that like button and subscribe to the channel for more no-nonsense financial strategies. And if you're ready to see how your credit score fits into the bigger picture of Canadian real estate, you need to watch my video on whether the value of your home is bleeding or booming. Click the video on the screen right now, and I'll see you over there.